We have liftoff, folks, and it ain't the stuff you want lifting off. So this is what they call on Wall Street a parabolic move. It's a parabolic move. It's a slang. It describes something that goes up at a high rate of velocity and magnitude on a chart. So these are the things that are going up at a high rate of velocity and magnitude on the charts. The 10-year bond yield, all these bond yields, but the 10-year bond yield, look at this. That is absolutely mind-boggling. Remember when we were down here? This was supposed to be the resistance point. It looks like it won't stop. There's so many implications from this that Wall Street's not even sure. All we know is it's not supposed to go up like that. You know what else is not supposed to go up like this? Crude oil is breaking out. It is going straight up. It feels like that destination to 100 is inevitable, and that's not a good thing. And speaking of not good things and parabolic moves, mortgage rates. Oh my goodness. I mean, how's this housing market going to move? If you've got a 3% mortgage, you're not going to go for an 8% mortgage. So that's something that's obviously crushing us as well. And you can see it. This morning we got the pending home sales. Wall Street thought it would be down 1%. Instead, down over 7%, down almost 19% from a year ago. So listen, here's the thing. They say the Federal Reserve, when they do their thing, they're trying to break things in the economy, just anything, like a bull in a china shop. And, well, I got to tell you, when they break these things, they also break Americans. They shatter our dreams. They shatter our aspirations long after the dust settles. So we have a very special guest we want to start the show with. He spoke at the Peterson Institute this morning. His speech was titled, "The 2023 Economy, Not Your Grandpa's Monetary Moment." Want to sit it down at D.C. right now. Edward Lawrence sitting with Chicago Fed President Austan Goolsbee for this exclusive. Edward.
Yeah, Charles, thanks for that intro. Yeah, Austan, I appreciate Austan Goolsbee, Chicago Fed President here. Thank you for joining us. I want to get right into it with the rates, your wheelhouse. You said your grandfather told you not to buy stocks.
Yes, that was his advice. Scarred from the Great Depression. Well, historical lesson, not.
I mean, maybe we need to listen to that because you have two. The Federal Reserve is saying that there'll be at least one more rate hike. That's the forecast that we're seeing from the Federal Reserve. But the market is pushing back and saying, well, maybe we think they're done. So what's your message then to the market now?
Well, it was a little different. If you look at the SEP that came out of the last meeting, the median was one more rate increase, but there was a sizable, more than a third that were for holding. I don't think it's wrong. What I've been saying is we're rapidly approaching the moment that if we see what's happened with inflation continue, which is it's come way down from its peaks, that the argument is not going to be about how much more should we be raising. The argument's going to be, well, how long do we need to keep it here?
But PCE inflation is coming out tomorrow, and the trend has been gas prices are up. You just saw Charles talk about that. 3% and rising for overall, but core is kind of staying steady or maybe even just staying right around that level. Is that mission accomplished for that month then if you see overall going up but core staying where it is?
I wouldn't call it mission accomplished because we're still above the target inflation rate. So inflation still has to come down. But if you take a step back and you look at the last 3 months, we got on the CPI side, core inflation is down to 2.4%. That's come down far faster than anyone predicted. And it's sort of why I made the argument, this isn't your traditional moment. The traditional argument is you have to break the economy if you want inflation to come down. For a variety of reasons, supply shocks, Fed has established credibility, and some other things. That doesn't have to be true. And let's at least try, though we got external shocks coming, as you say. Oil prices is a real one. Auto strike, if it extended for a long time, that would be a real one. You've got slowdown in China and other threats. But in the face of that, let's try to pull off this golden path landing.
So then are you okay with around 3% inflation, you say, for longer through the presidential election then?
No. I'm not okay with 3% inflation. That's not the target. Inflation has to get to 2%. My argument is we're on the way there, and we don't have to have a major recession to keep getting inflation down, which in normal times you do. And that's kind of the grandpa's historical lesson that I don't think is.
So I want to bring in Charles just in a little bit, but first I want to ask you, this morning I was on a picket line in Wayne County, Michigan, and I heard from those strikers that this is hard on them. The strike fund doesn't go as far as their paychecks go. Right. So it's a real financial burden for them. Have you seen a financial impact in the economy yet because of this strike?
you haven't seen much in the data. And if we have a government shutdown, we're not even going to get the data. So it'll be relatively hard to look in the data. At the Chicago Fed, the 7th district, we have the most auto production of any of the districts of the United States. So we have a lot of expertise in looking at this. If you look at past strikes in the auto sector, the short-run impact, if the strike is not expanded and extended, you don't see very much of it in the data because for whatever it goes down, it comes rebounding right back up. So all of the analysis here, 75% of the analysis here is how long is this going to go? And 25% is will the tight inventories that coming out of COVID that we've seen make the impact different? Are we going to see price impacts on cars, for example, which we haven't seen in previous strikes?
And now I want to bring in Charles. Charles, I know you're itching to get a question in here.
Charles, how are you?
My man,
been a while.
First and foremost, Austin, congratulations, okay? You and I have gone at it for about 20 years. Here's the thing. I know you to be a political creature as well as
I'm a Fed
just a little
man
bit.
now.
Just a little bit.
I'm not that.
And I like what you were saying about this traditionalist thing. You know, every time I talk about the Fed with regular folks, they're wondering how come that it has to be this way. How come the Fed has to take a mallet and just like a blind, like a bull in a china shop, break everything up? But then you kind of qualified it that maybe this time, how about just, I know you guys have these conversations, you push, pull. How about the notion that maybe we don't need to break everything up before we can call mission accomplished?
Yeah, Charles, I knew when I was talking, I knew you were going to be torn because you were going to say, wait, I think I agree with him. And you were not going to know what to do with yourself. Look, the philosophical version of the question of maybe in every moment do we have to say there's not a trade-off? I don't know. In a lot of moments, there is a trade-off. But at this particular moment, because of what happened in COVID, because we have been dealing with all these supply chain interferences, labor supply problems, some of that stuff can fix itself. And I think that we don't automatically have to break things. And the way that manifests rubber hitting the road is just because they announced that GDP growth is 2% instead of 1.3%, that's not an automatic that we're off the target to get back to inflation.
Right, and to that point, we always try to come up with analogies. I mean, I'm thinking if there's a hot air balloon and you shoot a hole in it, it's drifting back to Earth. You don't have to keep shooting at it, right? So I started the show with a lot of this economic data that's starting to fall apart here. I heard Ed Edward ask you about this auto strike. We heard from this morning CarMax, which I think is a really good proxy for the industry and the economy. The stock is getting annihilated. So there's obviously signs that this is kind of working, but you do have the hawks who seem committed to this, and that's what's hurting the street. Maybe it's part of it, Austin. I've always thought the jawboning was, that arrow in the quiver that sort of nudged things along. So maybe it's just the threat, the sort of Damocles, and it does the Fed's job for it. Does that play a role?
Maybe, and look, you see the long rates going up like that. That is a form of financial conditions applying a monetary tightening. The Fed has to look at the actual financial conditions when it's setting its monetary policy. If you feel like there needs to be tightening and the tightening is coming on its own through financial conditions, we absolutely need to take that into account. I just think, remind me never to get in a hot air balloon with you. You're like, let's stop shooting.
Don't get in one if I'm on the ground.
Why did you bring a gun on the balloon, Charles?
No, Austin,
what are you doing?
Don't get in the balloon if I'm down on the ground and you're in the balloon. I'm remembering some of those conversations we've had. So I've got a minute to go. It's just been tough, right? I mean, you guys are also human. And there's this human element that I think plays a role, particularly with Chair Powell having sort of missed the inflation thing. The transitory thing was a huge debacle, and being pressed that hey, listen, I know Paul Volcker. You know Paul Volcker. Remember that Senate moment with Shelby? So how do you take the human element out of it? All you guys have all of these folks got these PhDs. They think they're brilliant. When it doesn't work, they double down because brilliant people tend to do that. How do you, when you have these meetings with your colleagues, how do you take the human element out of it?
I thought you were saying something about me not being human, and I didn't know to object. Look, Charles, as you know, Paul Volcker was a great mentor of mine and a friend. I think Jay Powell is going to be remembered as a fabulous Fed president. And if we pull this off, if we could get inflation down this much without having a deep recession, I think they're going to name elementary schools, PS 2023 FOMC. This is a opportunity, not a guarantee.
Right.
And the only way to get the human element out, I think, is to have a lot of different viewpoints, which on the FOMC they are, and they express them, and we have that debate. That's the best chance we got.
The irony is that I've been feeling that way. I think Powell wants to, obviously, this is his way, it's redemption, it's history. And so last week at the FOMC meeting, it wasn't that he said he was giving up the ghost on a soft landing, but his body language sort of slumped, not the baseline. And, I know he's speaking tomorrow. I hope he comes out there and puts it back on the table. Yeah, we could maybe still get a soft landing, because I think that was a lot of nerves. Austan, congratulations again. Really, I really miss you. I miss our dust-ups.
Charles.
But we'll be waiting for you when you get off. I know it's a lifetime gig. You probably never want to leave. Hey, Edward, great stuff, my man. Thank you very much.